Hey there guys, Crypto Force here again, bringing you another daily dose of crypto. And today the video I want to talk about is cryptocurrency and taxes. Now, tax season's coming up. We're in the middle of it now actually. And I don't know if a lot of you all are really up to date on what the new crypto laws are concerning taxes. But I think this is going to be a really good video. It should be very informative. I did get a lot of my information from a CNBC article that they posted about cryptocurrencies and what you need to understand about the taxes, and I will post the link to that in the description below. And I also want to go into what some of the terms are they're using and the percentages that they're talking about here. So let's get started. So as far as cryptocurrency goes, the IRS has decided they will be taxed as capital gains. Now, if you don't know what capital gains are, they're profits from the sale of capital assets, which could be shares of a stock, a business, a parcel of land, a work of art, and they're generally included in taxable income. But typically they're taxed at a lower rate. Now, some of these rates I'm talking about, and I'll post a link to this Tax Policy Center also in the description below. Some of these rates I'm talking about all have to do with how much you make annually. Now, if you hold a capital gain for 1 year, then you are taxed at a different rate. If you hold it for less than a year and you sell it short, and we'll get into the intricacies of what determines on what a sell is here in a minute. But if you sell the capital gain, or I'm sorry, if you sell any of your crypto tokens or trade them before you've held them for 1 year, they will be taxed as capital gains and as income. So it'll be hit with a 30% right off the bat tax. Now, if you hold it for at least a year, then depending on what tax bracket you fall in, like if you fall in the 10 to 15% tax bracket, you'll pay no tax on the long-term gain on most of the assets. But if taxpayers that fall in the 25 to 35%, sorry about this highlighting crap, if you fall in the 25 to 35% income tax bracket, you pay 15%. And for those of you that are in around the 40% tax bracket, you pay 20%. So if you hold it for at least a year, you'll probably save half your money that you would typically be paying on taxes. So it is crucial that you know that. And here's some of the intricacies that we'll get into as far as what constitutes an actual transaction or a sale of a capital gain. Now, if you exchange a token, one token for another, like if you want to participate in an ICO, what's going to happen is if you take that Ethereum token and you trade it in for, let's say, let's say you were in D-Markets ICO or something to that effect, what's going to happen is if you've held it for less than a year, that will be counted as selling the asset. Even though you traded it, they're still going to consider it a sell of the asset. So you'll be hit with regular income, which will be a 30% tax on it if you held it less than a year, because the token is being treated as being sold, so it's going to generate a capital gain or loss. Now, if you receive payments in crypto in exchange for products or services or salary, it's treated as ordinary income at the fair market value of the coin at the time of the receipt. Spending crypto, so that's a tax event, and it may generate capital gains or losses, and it can be short-term or long-term. So say you bought one coin for $100. If that coin is worth $200 and you bought a $200 gift card, there's a $100 taxable gain depending on how long you held it. So it could be a short or a long-term capital gain subject to the different rates we were talking about, whether you held it for a year or not. If you convert cryptocurrency to US dollars, so if you go on Coinbase, you have your Bitcoins, you've made some money, so you're saying, okay, I'm going to cash out, and you go to the Coinbase and you cash out $1,000 worth, and you've held it less than a year, it's going to be taxed at 30% because that's going to be treated as it being sold, and thus it generates capital gains. Another way they're hitting you, airdrops. They're considered ordinary income on the day of the airdrop, and the value will become the basis of the coin. So when it's sold or exchanged, there will be a capital gain. So even airdrops are being hit. And here's some of the kind of where it's getting kind of ridiculous. Mining coins. It's considered ordinary income equal to fair market value of the coin the day it was successfully mined. Now, don't ask me how the IRS is going to know what you mine and all this stuff. I'm just saying, if you want to stay totally legitimate, these are the laws. So even mining coins being hit, but I don't think they're taking into account the power that you're using to mine the coin, the cost of the mining rig, the upkeep of the mining rig. So I think the mining thing is totally unfair in my opinion, but you do what you want to with this. I'm just throwing out the facts of what these laws are. So initial coin offerings, they don't fall under the IRS's tax-free treatment for raising capital. Thus, they produce ordinary income to individuals and businesses alike. So all these will be hit at around a 30% rate. Ultimately, I think that you need to make sure that you're up to date on these laws. And like I said, you do what you want to with it. But the bottom line, the regulation behind all this stuff that we're seeing right now, it's not about keeping people safe. Ultimately, it's about making money off of it. The government doesn't care about anybody. They care about how much money they can make. So don't let that fool you. And it's kind of a slippery slope right now because a lot of the senators, the congressmen, you're getting a huge surge in people saying, yeah, we need to regulate. And even Ripple's CEO, which I need to do a separate video about this, but he's all about centralization and trying to get cryptocurrency totally regulated. And that is totally wrong in my opinion, because cryptocurrency is really born out of decentralization. That's really the awesome driver behind it. But one last thing to add about the taxes: digital exchanges are not broker regulated by the IRS, so it makes matters more complicated when you prepare your tax documents. So if you traded cryptocurrency, exchanges don't issue a 1099 form, and they don't calculate the gains or cost basis for the trader. So many of them don't even allow transacting in dollars, instead opting for Ethereum. So this means that self-reporting is necessary. So exchanges are starting to take note of tax reporting, but Coinbase, for example, they now provide you a Form 1099-K, but only to certain business users and GDAX users who have received at least $20,000 in cash of cryptocurrency, and it has to be related to at least 200 transactions in a calendar year. So if you fall under the $20,000 cash for sales on Coinbase, you should not receive a 1099-K. But I hope this helps you guys out. I know the tax thing, it's kind of scary. And if you didn't know this already, you can sell stuff on Craigslist for cryptocurrency, which is awesome. But I have a feeling the IRS will probably start hitting that next. But anyways, guys, if you guys like this video, please share, subscribe, and like. Like I said, I'll drop these links in the description below. And hope you guys have been making some good trades. The market seems to be coming back. Bitcoin breached 10,000 today, so I think this is going to breathe some new life into cryptocurrencies. And as always, guys, I hope you guys are making great trades. And Crypto Force signing out.